Welcome again, everyone, to another Lunch and Learn in our ongoing Financial Friday series. Sainies is excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Equitable has been a long-standing presence in New York, and a large portion of Equitable's New York client base is built upon the work they do within the public education system. Through Equitable, Sainies members can receive competitive insurance rates and a full array of retirement services, including a complimentary financial profile for Sainies members, which we urge you to take advantage of it because it's a great benefit. Our Equitable presenter today is Luke Yanklowski. Before we get started, please note that participants are muted during the session, but we will have some Q&A time following the presentation. If you have a question, just type it in the Q&A panel or in the chat box. We are also recording this session and it will be available at sainies.org within the next week. And with that, I'll turn the presentation over to Luke.
Hi, everyone. Thank you for being here today. I hope you've all enjoyed some nicer weather we've had across the state on what hopefully is your week off. So I'm going to go ahead and share my screen. So what we're going to cover today is taxes. So obviously it's tax time. And in my office, we actually have a running joke. There's two things that people cannot escape in life, and that would really be death and taxes. And with that, taxes having to be filed in just a couple of days here, about a week here, April 15th, I just found a fun fact the other day that 25% of Americans will not file their taxes till about a week before taxes are due. And honestly, I thought in my head it would have actually been a little bit higher, but there's probably some of us on the call that still need to file because we do still have a week. So what I'm going to cover today is just first going through just the basics of taxes and then kind of go into more of some tax planning strategies. So I just need to take 10 seconds and go through the disclosure per my compliance department. So if everyone could just take 5-10 seconds, read over this, that would be great. So first, we're going to look at the different ways in which somebody can file their taxes. And the two most common ways are up here: single filers and married filing jointly. So just so everyone's familiar, there's quite a few different tax brackets. There's the 10, 12, 22, 24, 32, 35, and 37% tax rate. The more, those are federal tax rates, and the more income somebody earns in a year, the higher of a tax bracket they're going to fall into. As far as 2023, the tax rates stayed the same, although the taxable income brackets did adjust a little bit, which they typically do each year for inflation. Now, something that's important to note is there are 3 different types of income reported on a tax return. Or on your taxes. There's first earned income. So this is going to be income that you earn through your employer. There is then going to be unearned income. Common forms of unearned income would be like pension income, Social Security income, rental income, or common unearned income. And then there's also investment income as well. So this would be like dividends from stock investments, or if you sold the stock for a gain, you have capital gain investments. So looking over on that right-hand side, we can see this are the tax rates and taxable income brackets for single filers. So what we can see here is at 10%, really for anyone making between $0 to $10,275, they're going to be paying 10% on that income. And then it increases from there. So 12 is from $10,275, 41 $775. And for married filers, all these numbers are effectively going to be doubled. And I'm going to talk a little bit more about the actual tax brackets and how they work on a future slide. Now, the second way somebody can file their taxes is married filing separately. So in certain circumstances, married filing separately can make sense. Overall, the IRS definitely incentivizes people to either file married filing jointly. But what married filing separately is, you have a married couple who effectively they decide they just want to do separate tax returns. Some instances where this can make sense. So if somebody has high deductions based on what most commonly would be medical expenses. So if they have a lot of medical expenses, you can deduct them, and it may make sense to, because of that, file separately. The other is liabilities. So if your partner or spouse has some tax issues that you don't want to be liable for because you filed jointly, you then become liable. It may make sense to file separately. But there are definitely some major things to consider when filing separately. The first is you lose the benefit of a child and dependent care tax credit. You also lose any education tax credits or the ability to deduct student loan interest. Furthermore, if you're filing married filing separately and you make over $10,000, so you're beyond the 10% taxable income threshold, really you can no longer contribute to an Roth IRA. So Roth IRA normal income limits are quite a bit higher for an individual. It's over 120,000, where it's then limited to 10,000 if you are filing separately. If we look at the right-hand side, what we can see is the actual taxable income brackets and the rates, though, are all the same for a married filing separately as a single filer. Going into the third way we can file taxes, it is head of household. So head of household can be extremely advantageous for somebody that is unmarried or in a stage of separation, and they're paying for most of the expenses in the house. And furthermore, they have a dependent that they are paying for as well. Really, the IRS gives people that are filing head of household some pretty significant tax breaks. So one thing they do is they increase the standard deduction, which I'll get into a little bit more on a future slide. But basically, it's the amount that the IRS is not taxing of your income. So they increase that amount, and they also have higher income tax bracket thresholds. So again, if we look at this 10% tax rate, the taxable income bracket now moved from 0 to 10,275 to 0 to 14,650. So the idea is somebody that's filing head of household, if they are able to or qualified to, definitely should versus filing single, because they're effectively going to pay a lot less in taxes due to the tax breaks the IRS gives you. Now, one of the biggest misconceptions when it comes to taxes is if I hit a certain tax bracket threshold, I pay that percentage on every dollar I earn. So if I break into the 22% tax bracket, that means I pay 22% tax on everything. That's a common misconception, but in actuality is not the way the US tax system works on a federal level. The US tax system is considered progressive, or another way to think about that, other common terms would be a laddered approach or a spillover approach to taxes. So to go through an example, if I'm a single filer and I have $92,000 in taxable income, that would put me in the 24% tax bracket in 2022. Does that mean I pay 24% on all $92,000 of my income? No, it does not. What it really means is I only pay 24% on anything over the $89,075 to $170,050. So on my first approximately 10,000 of income, I pay 10% federal taxes. On my next 10,000 to 41,000, so roughly 31,000 of income, I pay 12%. From 41 to 89, I'm paying 22, and then just over the 24% is what I'm paying 24% on. So again, it is a progressive system. It is not a, if I break into the next bracket, I pay that on everything. Like I said, probably the biggest misconception when it comes to tax season. Now, a couple important things to know again along the basics of taxes. First, I've mentioned a couple of times the standard deduction. So when you go to file your taxes, you can either take the standard deduction or you can itemize your deduction. With the changes in the tax code in 2017, most Americans today are going to be taking the standard deduction. And what the standard deduction is basically the IRS allows you to have a certain amount of your income for free. That is the standard deduction. So in 2022, if you were single or separate, it's $12,950. As a joint couple, it's $25,900, and then a head of household, it's $19,400. All those numbers did increase a bit in 2023, as they do every year. But if I make $100,000 of income a year and I'm a married couple, or me and my partner do, well, then we can deduct $25,900 in 2022 and get that portion of our income actually tax-free. Now, another approach somebody can take instead of taking the standard deduction is they can itemize their deductions. So there are certain expenses that the IRS allows us to offset against our income. Common ones would be like medical and dental expenses, taxes and interest paid on mortgage or student loans, and then as well as gifts to charity. If those expenses are greater than the standard deduction, so if our itemized expenses are $30,000, instead of taking a standard deduction of $25,900, we can take our $30,000 in itemized deductions and have that portion come to us tax-free. Most CPAs, accountants, online tax preparers, whether it's H&R Blocks, TurboTax, will automatically run both to figure out which one's going to be more advantageous. I would say today, probably 9 out of 10 people are going to be taking the standard deduction, because for most, it's hard to come up with enough itemized expenses to be greater than the standard deduction. But if you can do so, it would make sense at that point to itemize. It's an important conversation to have with your tax preparer, your CPA, whoever it is, to look at, is it going to make sense to itemize if you feel you're in a point where you do have a good amount of deductions in that space. So transitioning over to some very common tax forms. Really, the most common tax form everyone's going to get is the W-2. That's basically your income statement from your employer. And one of the important components I like to talk about here, because I would say every single year I get questions about it. People reach out to me and say, hey, where's my contribution form for my 403B or my 401k or my 457? And any employer-sponsored qualified retirement plan contributions for a year are already built into your W-2. So if you've made $100,000, you contributed $10,000 to a 403B, that is already built into the W-2. So when you hand it to your CPA, your accountant, they are aware of that in that form. You don't need a separate form for that. Other common forms are a 1099. Now, there's a lot of different types of 1099. Someone can also have 1099 income, but there could be dividend, interest, and many others. So if somebody has an investment account that's kicking off some dividends, or maybe they have some capital gains because they sold the stock, they would receive a 1099 from that employer, or not that employer, that financial institution. In addition to that, if they took a distribution or did a qualified rollover, they would also receive a 1099. So it's very important to look at those 1099s and file them with your taxes. But if you, or maybe you've done in 2023, if you moved money, maybe you had a 401k that you did qualified rollover into a 403B, and that was from Fidelity to Equitable, for instance. The sending firm, so in that case, Fidelity sent the funds to Equitable, is the firm that sends the 1099-R. So it's a 1099-R and it's coded letter G. It is marked as a distribution. So every single year I have clients of mine reach out to me and say, oh my God, I had $100,000 rollover. It's a taxable event. And it's really not. You just have to look at the form and you'll see it's a non-taxable distribution, but something to definitely pay attention to. Just look at your 1099s when you get them. 99.9% of the time, they are coded correctly, but mistakes do happen. So that's with your W-2 as well. Just make sure you take a look at them. Now, another common one would be a 1098. So 1098 is where you report your interest on your mortgage or student loans. So this would come directly from your student loan company or your mortgage company. From there, the one other form that I don't have listed here that's definitely important is a 5498. So if people make traditional IRA contributions, you don't have a form for that you bring to your tax preparer. What happens with a 5498 is you just tell your CPA, your accountant, whoever, how much you contribute to the IRA. Then as you file your taxes, that gets sent to the IRS. The IRS then confirms that with the financial institution that you're contributing to the IRA to. And then the financial institution says, yep, and they send you a 5498 just to confirm your contributions to the IRA that year. So 5498s typically come in May. And again, they are for contributions to an IRA made throughout a year. So building a financial strategy with some taxes in mind. There's really two different types of strategies we want to look at when preparing our taxes. First is how to reduce our taxable income. Second is how to leverage tax credits. So everything on the left-hand side of your screen is really how we can get a tax deduction. A tax deduction is we are lowering our taxable income. So for instance, the first bullet is saving into a pre-tax retirement account. So if I save into a 401k, a 403b, or 457, I am lowering my taxable income. I'm getting a tax deduction for that. However, if I make $100,000 and I contribute $10,000 into my 401k, that does not mean I paid $10,000 in taxes. It means I lowered my income $10,000. Where if we look and compare that to a tax credit, if I owe $20,000 in taxes and I got a $10,000 tax credit, I literally now have to pay $10,000 less in taxes. So a tax credit is actually more advantageous than a tax deduction. It literally lowers the amount of taxes you owe dollar for dollar per the credit. Now, some major ways we can reduce our taxable income. The first, as I just said, is saving into a qualified retirement plan. The next would be saving into a health savings account or a flex spending account. So these would both be health expense related. Health savings accounts are only available for people on high deductible health plans, where a flex spending account is for other health plans. Health savings accounts roll over each year. Flex spending accounts do not. They have to be used in that given year. You could also save into a 529 plan. A 529 plan does not give you a federal tax deduction, but it does give you a state tax deduction. From there, you can also, if you take the standard deduction, you can make charitable donations and get a deduction for that on top of the standard deduction. If you're a single filer, you can deduct up to $300. If you're married jointly, you can deduct up to $600. So if you're making charitable donations and you haven't in the past, just make sure you're getting the tax deduction for that. You do have to show a receipt for that, but you can get above and beyond the standard deduction deducted from your income. There is also an educator expense deduction. So if you are an educator, every year when you set up your classroom and throughout the year, there's expenses associated with that. Maybe you have to buy books, maybe you have to buy cleaning supplies or pens, pencils, pencil sharpeners, all sorts of different things. You can get up to a $300 tax deduction for that per educator. So if you're married filing jointly, one is an educator, one is not, you can deduct $300. If you're both educators, you can actually deduct $600. Now, as far as other things that are deductible, if you pay for health insurance, that is a pre-tax deduction as well. That is a very big one in this space. But commonly used tax credits. So I won't take too deep of a dive into each one of these, but just be aware that they're out there. And if you think you might want to learn more about them, certainly you can talk to me, you can talk to your tax preparer to kind of go through the ins and outs of them. But you get a credit for if you have children 16 or under, or if you have dependent care. If you are paying for education expenses or going back to school yourself, there are education credits in the American Opportunity Tax and the Lifetime Learning Credit. If you adopted, there's a tax credit there. If you earned income under a certain threshold, under a certain formula, you get a tax credit. If you installed solar panels, there's some tax credits. Or actually, if you saved into a 401k or 403b, on top of the deduction there or an IRA, there can also be a tax credit just for saving into retirement accounts. So again, if you feel like these could potentially make sense for you, just talk to myself, talk to a professional talk to your tax preparer to see if you can get these tax credits. They are powerful. As I said before, they lower your taxable income dollar for dollar. Now, what I'm going to transition to is more so specifically retirement accounts, how they can help reduce taxable income today, but also how they can help reduce taxable income in the future. So when we think about preparing taxes and tax strategies, obviously today is very important, but preparing or lowering our taxes and having tax strategies down the road is also important. So if someone wants to reduce their income today, so if we look at the goal portion, one thing they can do is either start saving into a pre-tax retirement account or increase their pre-tax retirement account. So talk to people every day. They say, every year I owe on my taxes. Well, one thing they can do instead of paying that money to the IRS is increase their 401k or 403b and then ultimately pay themselves instead of paying the IRS. If somebody wants to decrease their future income taxes, which, as I would say, most people feel if they had to look at taxes, if we looked at are they going up or down, I would say most people are in line that taxes will probably go up in the future. So it is a good idea to implement some strategies to reduce future income taxes. They could start saving into a Roth or increase their Roth contributions because that'll be after tax dollars in retirement, which can be important, especially for many New York State employees. So we're saving into a 403b, if we're saving into our New York State pension, and then we also have Social Security. Those are all taxable forms of income. So if taxes are going to go up in the future, we might want to add some Roth to give us some tax-free income. If we want to reduce our income taxes dollar for dollar, certainly look into this or seeking the tax credits, and then can we potentially qualify for the retirement tax credit, as well as avoiding major penalties. So certainly I understand life happens. Sometimes people have to take distributions from the retirement accounts, but when possible, not defaulting on loans we take from retirement accounts or taking hardship withdrawals or early distributions, as certainly those all cause taxable events and definitely hurts to get that bill that next year. So just looking at an example, a little bit of a case study of reducing current income with taxes with pre-tax contribution. So let's say John Smith, he has a gross annual income of $50,000. He makes annual contributions of $3,000 to his 403b. That means he then has a taxable income of $47,000. We assume John has an effective tax withheld or effective tax rate of 20%. That's what he's paying between both state and federal taxes. And really, effective tax rate means the actual amount you're losing to taxes. So if I have enough income and I fall in the 24% tax bracket, that's my marginal tax rate, but I don't pay 24% on everything. 20% or my effective tax rate is the average income tax bracket I'm in. So John's losing about $9,400 taxes of the $4,700, meaning he has a net income of $37,600. The advantage of saving into the 403b, the $3,000, is he saved himself about $600 in income taxes because 20% of the $3,000 is $600. So this is where it can be advantageous to save in a pre-tax account. Instead of paying that $600 to the IRS, he paid himself in the form of saving for retirement. The other big advantage to a pre-tax retirement account is there does become a little bit of a behavioral finance or psychological standpoint to it. You can effectively save more and have it feel like less. So if I'm contributing $500 a month towards retirement and my effective federal and state income tax rate is 25%, really what I need to budget for is the $375. Because if I take that 25% times 500, that's $125 that I'm losing to taxes if I have $500 going to my paycheck. So if I have $500 going to my paycheck, by the time it hits my bank account, it's actually $375. So if I want to save that $500, I only need to budget for $375. So it is a great way to save more and have it actually feel like less for budgeting reasons. Now, transitioning into more of a Roth scenario. So Roth contributions are made with after-tax dollars. So it's very powerful because then you get tax-free growth. The only time you wouldn't get that tax-free growth is if you took an early distribution or the account wasn't open for 5 years before you took a distribution. Now, there are limits, there can be contribution limits and income limits that apply to specifically Roth IRAs, and then contribution limits apply to all retirement accounts. But to just look at an example here, so if you were to set aside $3,000 a year in after-tax Roth contributions for 10, 20, or 30 years, and assuming a 6% growth, we can see down here in the left-hand corner. So if I saved $3,000 for 10 years, and got 6% growth, after that 10 years, I'd have $41,915. I put 30,000 in, that was my contributions over the 10 years. So my Roth after-tax earning is $11,915. That's $11,915 I earned in interest that I will never have to pay taxes on. Looking at 20 years, so it compounds, then I would have $56,978 that I never have to pay taxes on. Or at 30 years, $161,405 of interest. So in that time, would have put $90,000 in. So that $161,000 of interest, I never would have had to pay taxes on. If you had an effective tax rate of 20% in retirement, that means you just saved yourself $32,281 in taxes in retirement. I'm sure everyone would like another $32,000 back in their pocket in retirement. To kind of give you an apples to apples comparison, if I had a pre-tax 403B and I wanted to produce the same $161,000 of income, I would need about $201,000 in that account. Because then if I lose 20%, I'm going to finish with about $171,000 or $61,000 net. So just some key points to remember. So you should review and consider changing retirement contributions every year. I always advocate just make a small incremental increase each year. It will go a very, very long ways. And then if you've consistently increased into a pre-tax account, consider opening and starting after-tax accounts, because just like we want to diversify investments, we want to diversify our tax situation as well. It is definitely important to do your homework and seek out tax credits and other tax deductions you could potentially be eligible for. Especially, you may be doing these things already. You might as well get the tax break for doing them. And then try to prevent as best you can any defaults, hardships, things of that nature that are going to cause a significant spike in our tax situation. And make sure you're consulting professional. Taxes are very complicated. The IRS tax code is literally 78,000 pages long. It's very, very complicated. So just make sure you're working with a professional to most adequately put you in the best spot when it comes tax time. Thank you.
It looks like we do have one question from one of the attendees in the Q&A box. They want to know, doesn't your contribution to a 403B save you on your federal return, but the dollar amount contributed is reflected on New York State return as unearned income?
So as far as contributing to a 403B, as far as the specific reflection, I don't know that I understand the question completely, or I'm answering the question completely. But yes, you do save on both federal and state taxes. Is that reported at an unearned income on your state taxes? I'm unsure, but you do get overall a state tax deduction on top of your federal tax deduction. It's reflected on New York State returns. I'm not sure if that answered that question.
Oh, okay. Yeah, maybe they can contact you off list, or for further information. It looks like we don't have any more questions at this time, so please go to the Saini's website to contact your local Equitable representative with any other questions you might have. And thanks again, Luke, and have a great weekend, everyone.
Thank you all for your time. Thank you for being here.